In this video, I'm going to give you 10 investments to or to not make in a recession. We'll talk about the best and the worst. Let's get started. Number one, robotics. Now, this might sound crazy. Like, why would you want to invest in robotics or robots in the next recession? Well, that's because I believe this next recession is going to be very unique. And this video is not going to be about why I think we're going to have a recession. We know there is going to be another recession. We don't know exactly when that's going to be, but this next recession will be the first real recession where we actually have broad-based use of artificial intelligence and potentially, to some extent, robotics as well. This means industries from logistics, diagnostics, underwriting, any customer service or sales, a slice, maybe if it's only 10, 20%, still a lot, of all of those workers might be replaced by artificial intelligence and robotics, especially in a recession. See, here's the real problem. Most companies don't like doing layoffs. They prefer doing what are called quiet layoffs. They're basically a way of saying, we're going to make things a little less cushy and comfortable around here and kind of hope that you leave because it'll lower our costs, which will increase our bottom line. And frankly, ever since we sort of opened up our economy to China, costs for labor as a percentage of corporate profits have been plummeting. Put in another way, workers are making less money and corporations and stockholders are making more money. Now, in a recession, stockholders get punished. We'll talk about that in just a moment. But this will be the first recession where artificial intelligence and robotics is at play to not contribute necessarily to the recession, but to actually make the recession longer and harder to get out of. See, remember, a recession is a period of time, usually 2 quarters in a row of negative GDP, and a period of time of uncharacteristically high unemployment. See, we actually had 2 quarters of negative GDP in 2022, Q1 and Q2, but we didn't really call that a recession because the unemployment rate was really low, around 3.3%. So it wasn't considered that we were in a recession, even though stocks fell 30 to 70%. Certainly felt like we were going into a recession, but people haven't had enough money to keep spending up to some extent. Yeah, growth estimates came down, but nobody really got laid off during that quasi-recession. Instead, the recession that I'm talking about would be more of a Great Depression or 2008-style recession. And this recession will be the hardest and will take the longest amount of time to get out of, because ordinarily what happens in a recessionary period of time, like what we saw during the 2003 era, March of 2003, we had the Federal Reserve essentially bail out the stock market and companies started hiring again. You had that happen in February of 2009. You had that happen in March of 2020 during COVID. To a smaller extent, you had the bond market rescued by the Federal Reserve at the end of 2018. So the Federal Reserve is sort of known for trying to Fed put the markets, basically prop up hiring. But the issue is companies right now may not be laying off heavily because they prefer that quiet laying off I talked about. And what happens is they sort of wait to lay off until really everybody is laying off, because then their stock prices get punished less. And that means there's a higher likelihood of many companies laying off people rapidly all at the same time. And the downside of that is, where are those people going to get jobs? We barely have enough jobs today to cover everybody who's unemployed getting a job if they were perfectly matched, assuming all the job postings that are open today are actually open. Sometimes people forget to take job postings down. Happens a lot with, the job posting websites like Indeed and otherwise, because those platforms sort of incentivize you to forget about your job posting so they can keep collecting revenue. It's a problem. Probably skews some of the numbers. But now imagine you add to, say 6 million unemployed and 6 million job openings, add 10% of people losing their jobs. Well, that would be another 15 million. You could be in a place of 21 million unemployed people and only 6 million jobs. And if half of those are fake or disappear, you've got 3 million jobs available for 21 million people. Your workers available to jobs ratio would be 7 to 1. It would be a miserable, miserable depression. 21 million people unemployed would represent an unemployment rate of around 13.2%. And it could happen very rapidly. Placing these people back into jobs in the era of robotics and artificial intelligence is going to be hell. It's going to be very, very bad. And this is why part of me is really tempted to expand my investments into robotics. I'm doing due diligence right now on some robotics companies that are private, and I might be making some VC investments on top of the VC investments I've already made into some of these robotics companies because I think some big changes are coming. Stay tuned to the channel. We'll have more information on these deals that are going on. Number 2, let's talk mortgages. Now this one doesn't sound as fun as robotics. Robotics, I mean, and I want to separate quickly robotics from AI. I don't mean AI, right? I don't mean like investing in ChatGPT at $158 billion when, you know, these language nets are just going to be a dime a dozen in a few years. In a few years, Apple will have one. Google's already got one. Microsoft uses, obviously, OpenAI's GPT. Amazon's throwing money into Anthropic, which makes Claude. You've got Meta, aka Facebook, and Mark Zuck working on Llama. Everybody's got their neural net. Okay, this is not where you want to invest, in my opinion. Everybody's gonna have a neural net. That's not the place. I'm talking real robotics, like physical robots. Yeah, that actually integrate these neural nets. That's a big one. Okay, now we gotta talk mortgages. I know I'm blurring these together a little bit here, but I just wanted to clarify that to make that exceptionally clear. I also kind of think the chip market is played out because once the AI infrastructure is built out, you're not gonna see all these new orders for more and more and more AI. So I think there's some downside risk there. With that said, let's talk mortgages. Now, mortgages, this sounds extremely boring. Why would somebody want to invest in mortgages? Well, ordinarily, you wouldn't want to. Mortgages right now, a lot of them are locked in at 3 to 3.5%. Some people even locked in 2.7% on their 30-year mortgages. Big fan of the 30-year mortgage. Y'all know I'm a real estate broker, a big real estate investor, run a real estate startup, big fan of real estate. Also a financial advisor and, you know, got a bunch of broker-dealer related licenses. But the point of mortgages is mortgages actually go up in value, especially the higher interest rate mortgages, when interest rates come down. So when interest rates come down, we expect everybody who has a mortgage at 4, 5, 6, 7, 8%. First of all, their mortgage is going to be worth more than what it was previously. Obviously, there's some risk because some people could end up having to default on their mortgages. But if you get prime-rated mortgages, your default risk is usually a lot lower. You know, subprime mortgages you want to stay away from. But after Dodd-Frank and the ability to repay, I don't think the next recession is going to be a 2008-style recession. I think most of the people who have the ability to repay are probably going to be able to, at the very least, make their mortgage payment. It's not going to be the first payment they stop making. They'll be much more likely to stop making their Affirm buy now, pay later loan payment than they are to stop paying their mortgage, especially since they know that'll tank their credit and that they risk losing a valuable asset. Unless, of course, they're woefully upside down. But again, because of the ability to repay and because of prime mortgages, I don't actually think this will be a real estate-led crash. And that's why I think mortgages are so interesting. Now, don't get me wrong. Markets like Texas and Florida, they're having idiosyncratic problems. That means they're having their own problems where those markets were overbuilt during COVID because everybody's going there for freedom. Okay, great. Well, then you overbuild there with your freedom, and now you've got a glut of supply. Too much supply, prices come down, not enough new people coming because now people also have at least some freedom still in places like California. We like to say California. I'm from there, so I feel like I can say it. But anyway, what are you going to do? So my belief is that default risk on prime mortgages is relatively low. However, what's interesting is the value of mortgages goes up as yields fall in the marketplace. And in a recession, I expect the long end of the curve to fall as well. And then I think these mortgages will become more valuable. But there's also refinance risk. And this is why I specifically like companies that also originate mortgages. So that way they're making a new loan and collecting the fee on that loan. And so you get the best of both. You get a company that has a mortgage that becomes more valuable as you enter a challenging environment, assuming low defaults. And if people end up refinancing, hopefully before they lose their jobs, you end up capturing that refinance revenue, and then again, you have a quality mortgage. And I actually think if rates come down slowly, because we slowly back into a recession, then what you end up getting is potentially multiple refinances. You know, somebody refinances when rates drop to 5%, they refinance again when rates drop to 3%. It's an idea. Some options you might consider looking at here, and I've got some exposure to these, just keep that in mind. But Rocket Mortgage, I think, is probably your best positioned, and the stock has been on sale lately. United Wholesale Mortgage Company, another one, that's the number 2 one I'd rank. And I really rank these based on how much they actually have on their balance sheet in the way of mortgages, how much pricing power I think the actual brand has for doing loans, and their servicing rights. I sort of evaluate all of these on their balance sheets. The most risky out of all of these, but that has the most upside, is probably a Loan Depot. That's LDI is the ticker for that. You could also potentially play a stock like Redfin because they do mortgages, but you have to be really careful with this one. It's a lot more volatile. It's a great company and it's not going anywhere, but it definitely has downside risk as well because they make a lot of their money from actual transactions, less so mortgages, but they might be able to ramp their mortgage business really well during a recession. So mortgages are an interesting play for me. Especially residential. That's the other thing. The companies that I mentioned here, they all pretty much focus on prime lending, not subprime, ability to repay lending, and they focus on residential real estate. You kind of want to stay away even from multifamily. I'm a big fan of single family right now. Okay, next option. I guess another thing to look at here, selfish, shameless plug, if you will, right here. I actually think the investment option that we have open for HouseHack right now, househack.com, is really ideal because it's a convertible bond, basically. But if we go public at some point in the future, you get pretty much all of the upside because you get converted to stock, so you get all of the upside. But while we're not converted, you get paid 5% interest because you own a bond. And because the company basically has, less than 4% debt, which is very, very low, it's a company that we believe will do very well in a recession, be able to pick up some sweet deals. So check that out, househack.com. Not a solicitation here. Go read the PPM over there. There's a deadline on that one for December 13th, by the way. Okay, so number 3, stay away from this. This would be a bad one. So I think robotics good, private investments maybe in robotics, mortgages. There's risk here, but I think there's a lot of upside here as well, a lot more than people recognize because this is not going to be the single family crash. I think there's a dip opportunity on mortgage companies right now just because rates have gone so high, and I think they're really topping out. But we'll talk more about rates in a moment. Another one that I would avoid, or the first one that I would avoid, would be small cap stocks. I actually think small cap stocks like your Russell 2000 would probably be your absolutely worst investment. Right now, the Russell 2000 is sitting at one of the highest percentages yet for unprofitable small caps, with up to 40% potentially not able to pay their debts with the income they're making. This makes them zombie companies. Worst of all, these smaller companies are small for a reason. It's because either they're new, which makes them more at risk, or they're small because they've just never been able to grow up into a big boy or big girl. Some of these companies have been small caps for decades and they just don't grow up. This puts them most at risk of disruption and getting replaced during a recession, just straight up going bankrupt. So out of all of them, Dow Jones, S&P 500, NASDAQ, small caps are probably the most reckless investment that you could make in the stock market right now. And look, while it's sexy to say, oh, Trump is going to save the world, or, hey, there'll never be a recession again, or whatever, while it's sexy to say that, and it's really fun, especially when the stock market's going up, you got to be aware of your downside risks as well, because there's no such thing as a riskless investment. And this, if we're going into a recession, I just think is a reckless investment to make. Of course, nothing in this video is personalized financial advice. That's just my take. Number 4, I like cash. Now, this sounds crazy. A lot of people get mad at me when I say cash, but cash, they go, oh, cash is trash. Cash is not trash. Cash is opportunity. See, the reason Berkshire Hathaway and Warren Buffett have done so well is not because they could read the best balance sheet. It's because they wait. They have so much patience to wait for really good deals. And when those really good deals come up, they have the cash to buy. And that makes me very excited. Now, Warren Buffett himself doesn't actually go straight into cash. He prefers short-term treasuries, less than 1 year in duration. Now, one of the reasons those are nice is because you generally have good liquidity, you have low risk of principal loss, and the 1 year treasury right now, at least when I last checked, it's yielding a pretty good yield. The 1 year treasury, as of the recording of this, is yielding 4.4%, which is crazy. That's a pretty high number in my opinion. And the 6-month treasury is yielding 4.5%. Now, those numbers could change over time, but even if they're yielding 2%, I think they're a good opportunity for parking cash, because if you put money into a money market like a VUSXX, a Vanguard money market style fund, it's possible that those rates are going to plummet very, very quickly. So if you can lock in 4.5% for a year, or 4.3% or whatever it is right now for a year, and then in 6 months they drop rates substantially, at least you have another 6 months of that yield. Or just have straight cash sitting in like a, Robinhood or whatever. The danger with that is if it's in a Robinhood, you're probably going to swipe up some stocks and blow it. Number 5, high quality corporate bonds. Now, one of the nice things about high quality corporate bonds is usually in a recession, liquidity is so tight that you could generally get really discounted bonds on great companies that aren't going to go bankrupt, like Apple, for example. And you can often get, because bonds will sell at a discount when people need liquidity, you can often get some of these high quality corporates at excellent yields, potentially 8, 9, 10%, 11% on like an Apple corporate. You should be buying these all day long. Now, they're not always available and you have to hunt for these. And so this one's a little bit more nuanced and niche. Talk to your financial advisor or your banker about high yield bond options. And I'm sure they'll have a whole menu for you to pick from. If I wanted high quality corporate bonds, I'd just call up my bankers over at JPM and ask for help. You could probably do the same wherever you bank. There are plenty of advisors that would love to help you, especially at banks. They've got plenty of portfolio products for this, or market products as well. Number 6. Now this one is, people differ on this one. Just straight up longer term treasury bonds. So technically in a recession, you usually see bond yields across the curve come down. Let's assume this right here is like your 20 and 30 year, this side, and this is like your 2-year treasury. When you have an inverted yield curve, it means that your shorter term is actually higher than your longer term. That's broken. That's a warning sign of a recession. Well, in a recession, usually both go down, but the 2-year yield falls faster. That means even though the 20, 30-year yield's coming down, those mortgage rates are coming down as well, you're getting the 2 falling faster. So some people like to invest in the 2-year, but I don't actually think as an investment, the 2-year is a great option. It's too cash-like. So instead, what I like is investing in the longer-term treasury bonds, because I personally expect this next recession is going to be deflationary, not inflationary. A lot of people have different opinions than me on this, and that's okay. This is just my take. My take is this will be a deflationary recession that comes, and the longer on the curve you are, the more principal appreciation you'll see. talk about that in just a moment. But some options that you could look at if you wanted to. This is not sponsored. I have no affiliation with them. But you could just go to USTreasuryETF.com. USTreasuryETF.com. They have a nice option here, 5-year, 7-year, 10-year, 20-year. Another option, if you want to compare, would be like a TLT, which would be a 20-year, comparable to the UTWY over here. TLT is a really interesting one because it has a lot more liquidity. And one of the things you could do, just because they don't move that rapidly, actual bond prices, you might get like 10% bond swings in a matter of 4 months. That's not like a meme stock, it's kind of a low movement. But what I like doing is I like going out on the chain. And I'll be frank, like I bought some January 2026 versions of these, 428 days out. I overpaid for them because I bought them when TLT was a little expensive a couple months ago. So I made a little oopsies here, but I'm still very excited about this because I actually think TLT will go to 120. My base case is 120. My bear case is 105 to 110. And I know we're at 90 now, so you can buy the dip on that, but I'm saying over the next year. And then my bull case is that these are going to go back to 140, 150 bucks, this particular security, which makes options extremely desirable. And I think there'll be a very, very large payout on them. No guarantees, obviously. The timing could just be wrong, and I might close that position, flip-flop on it sooner. But right now, I'm very bullish on this because now I get a leveraged move on the longer end of the curve with options. I get a leveraged option on the longer end of the curve, which I think will come down in recession with the two. The two will go more rapidly, but because the principal doesn't move as much, I'm not really going to play options here. I'm going to play options here. And I've got liquidity. I need liquidity and I need movement in a recession for this bet to really play out. Might even go buy the dip, honestly, on some of these options that I have. So we'll see. Okay, so that is number 6. Number 7, this one is a good and bad. So the good is because, the topic here has to do with commodities. The good is going to be your gold, maybe even silver or platinum, your precious metals. Precious metals in a recession almost always do exceptionally well. And the nice thing about gold is it does well if you have inflation, and it does well if you have recession. It does well in both cases. Now, I personally don't think we're going to have a second wave of inflation, even when the Federal Reserve starts stimulating with quantitative easing. So that's why I chose bonds instead of gold. I also think gold has run quite a bit here on this fear of, a second wave of inflation or whatever. So I think the pricing is undesirable at this position. Then there are bad industrial metals. These are going to be things like copper and other industrial metals, because usually in a recession, those will plummet because production slows down. That should be pretty straightforward. Number 8, crypto is not going to be your protector in a recession. Cryptocurrencies and NFTs and meme coins, momentum coins, I like to call them, are going to do exceptionally well in a bullish market. Bullish stock market at all-time highs, high levels of greed, high levels of options playing and speculative appetite, and the belief that everything is roses going forward and there will only be perfection going forward. Cryptocurrencies are great in that environment, and they will continue to hit all-time new highs over and over and over again until, of course, the party stops. And when the party stops, digital gold, a la Bitcoin, will not protect you. I do not, unfortunately, believe that in a recession, certainly any momentum coin, like a meme coin, and certainly not your frankly your Bitcoins and your Ethereum, do not or NFTs. I do not believe any of these are going to protect you in a recession. They don't protect you against inflation, not at this point at least. And I think they really are more of an order book at this point of, to some extent, greed in euphoric times. That is great when things are great, but it can get bad very, very, very rapidly in a recession, especially one that lasts much longer than the COVID recession. So I would just be cautious in crypto when it comes to a recessionary environment. And anything that I owned that I was nervous about, I would just set good to cancel stop losses. So if I broke below a certain point, automatically just sells. Number 9. Now, don't get me wrong. I just want to be clear. Crypto, okay in a bullish, momentum environment. Number 9, a good investment could potentially be momentum to the downside. So something that people like to do in bearish environments is they will go out on the option curve, usually about 60 to 150 days, and they will buy puts. They'll buy puts on highly valued companies. They'll take, some of the favorites. I hate to say it. It's not to be, angry or evil to these companies. It's just they have high valuations. Costco, very high valuation. Wingstop, very high valuation. You've got Palantir, Tesla. These are all companies with very rich valuations right now. And these rich valuations will probably compress very rapidly in a recession. And you could catch that momentum to the downside. If you catch that momentum to the downside, you might be able to play it with options or even straight shorts. Just be careful. Everybody hates a bear. So you really don't want to tell anyone that you're shorting. Number 10. Investing in yourself. Now, I know this is crazy. I've got a bunch of courses, obviously, over at meetkevin.com. I send trade alerts. I send trade ideas. I do fundamental analysis, and I talk with my course members every day. The market is open about fundamental analysis and what the next steps of the current economic state are, what plays are potentially considerable, and what you might want to pay attention to. You could join any of those over at meetkevin.com, but no, frankly, if you want to protect yourself from that investment number 1, robotics, and you want to protect yourself, you got to get more skill sets, and you got to do things robots can't do yet. Be a pilot. Be an AI programmer. Become a robotics programmer. Go to school for mechanical engineering. Get a side hustle in these things even. You realize you don't even have to go learn this try to teach yourself some of these things. And it doesn't have to be your primary job. You could take a course, take a class, take something to elevate your education and something else as a hedge to what it is that you do. So, for example, if you're a real estate agent, maybe you want a side hustle going doing some night classes in nursing. Just saying, if you really have a hard time in sales, maybe this will be a backup option for you. I'm not saying that's what you want to do. You might think I'm crazy for saying it, but hey, worst case scenario, you get a 2-year degree or license in something that's functional, and it's always a fallback. The other and you can still use your real estate license for your own deals. Now you have a W-2 you can qualify with. Another thing to consider is trades. Learn how to do trades, electrical, plumbing, HVAC, framing, roofing, handyman work. Anything that you could do to get your butt on Yelp, on Upwork. Yelp stock, by the way, is very cheap right now. So is Enphase, but a topic for a different video. Whatever you can do to get your butt advertised as someone who's available for hire and you're insulated from AI. AI ain't going to replace my outlets anytime soon. That is something I would consider because the last thing you want is your income to dry up. So there you have it. 10 investments for recession, or not investments. Selling some of them and buying some others might be good. But these are my thoughts. Do whatever you'd like. Quick recap: robotics, mortgages, stay away from bad small caps, short-term treasuries and cash, high-yield corporate bonds, longer-term treasury bonds, bad commodities and good commodities, good being gold, bad being copper, bad crypto NFTs. Number 9, the only momentum you want is not upside momentum, but downside momentum. And number 10, investing in yourself. If you found this video helpful, make sure to subscribe. And folks, we'll see you in the next one. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.